over 250,000. Through Meyer Capital Group, we have the ability to set up customized portfolios. And it's very important because you can create an absolute legacy of this portfolio long after you're gone. And, one of the strategies that we offer is, I think it goes right from gifting from the heart and investing from the heart. Don't smile, Michael. Okay, so Michael Smithwick, portfolio manager at MCG and our resident ESG expert, is going to talk about exactly what I just said. So go ahead, Michael.
Thank you, Tom, and thanks to everyone who took the time to log in and gave me the opportunity to speak about sustainable investing, because I do love to speak about it, as Tom can attest to. It's one of my favorite topics. But we created a sustainable investing offering probably 4 or 5 years ago, and we've seen a lot of interest in it and a lot of growth in it. What is sustainable investing? So basically it's there's no standard definition of it, but we look at it as investing in stocks and bonds of companies that are focused on positive environmental, social, and corporate governance practices. So how does that look in real life? The way we do it in Meyer Capital is we invest in mutual funds and exchange traded funds that are having a sustainable lens on them. So if we think about a traditional mutual fund or exchange traded fund manager, they're typically doing research and putting together analysis on companies using various financial metrics to try to determine what's the best company to put in their portfolio. Sustainable investing fund managers do the same thing, but they also add to it some non-traditional factors, like factors that fall under the area of environmental, social, and governance. And just as an aside, you'll hear sustainable investing called many different things, and ESG investing is one of them. And that's where that comes from, is environmental, social, and governance. But these managers are not only looking for companies that they believe are going to do well financially and have a good return, but they're also making a positive impact in these 3 areas also. So just to dive a little bit into what this means, there are many, many different factors under each of these areas. But environmental tries to look for companies that are making positive progress in reducing their negative impact on the environment, things like reducing their carbon footprint and recycling and energy efficiency and so forth. The social piece of it refers to basically how these companies treat employees, or people, I should say, whether it be their employees or suppliers or vendors, what their company looks like from a racial and gender standpoint, and how they interact with and treat the community that they do business in. So that's sort of the social end of it. And then the final piece of it, the governance piece, is things like executive compensation, composition of the boards, and sort of their political lobbying activities and where their contributions go. So that's just a piece of what environmental, social, and governance could be, but there's many other factors out there that are looked at, and it depends on the company that's being looked at and the industry and the sector that it's in. So if I break down the sustainable investment strategies into 2 main areas, I could classify them as exclusionary investing and inclusionary investing. So exclusionary investing is sort of an older school approach. It's been around for decades, and it's basically the fund managers are actively avoiding certain companies or industries, and sometimes even sectors, in a portfolio to line up with a certain mission or value. So a classic example of this is religious organizations. They've been doing this for a very long time, and they will actively exclude companies from their portfolios that don't line up with their beliefs and their teachings and their values. This has been known for a long time as socially responsible investing, or SRI. And I've listed up here a couple of the classic exclusions in socially responsible investing funds. But these funds still exist, and they still manage this way and do very well. The one downside of these funds, I would say, is the diversification aspect. So as a portfolio manager, in any portfolio we're putting together, diversification is really important. We want to get good, broad diversification across industries and sectors and countries to maintain or to reduce risk in the portfolio. And when you're pulling out full industries and possibly even sectors, there are a few holes in the portfolio. And that's gonna be less diversified than if you were investing traditionally. And in the end, when you look different than traditional, say, mutual funds or indexes, your performance is going to be different. It might be good different, it might be bad different. It really depends on the time period that you're looking at, but it's going to be different. So the newer type of investing that falls under sustainable investing strategies is inclusionary investing. And what this does is, instead of excluding things from the portfolio, it looks to pursue companies or add companies that are pursuing sustainable business practices. And the reason this is an area that has grown significantly in, say, the last 10 to 15 years. And the reason it has is because there's a lot of data now available for fund managers to use that they can incorporate into their process. There are many companies out there, but there are a couple of big players, namely MSCI and Sustainalytics, that dig deep into public companies and rate them from a number of different factors under that ESG umbrella. And so these managers can now take that data, incorporate it with all the other traditional data they pull in when they're looking at a company, and see how they're doing from an ESG perspective or an environmental, social, and governance perspective, and incorporate that into their process. Another type of inclusionary investing is factor-based thematic, where it might have a narrower theme involved in the fund, like a low carbon or an alternative energy or a gender diversity fund. Another type of inclusionary investing is impact investing. So this is investing in something where you can have a very measurable and known outcome. So a good example of this is the green bond area. This is also another growing area. And again, there's no clear definition of a green bond, but when you think about a bond, a company issues a bond, they get the proceeds from it, and they use it for a certain project. And in this case, in the case of a green bond, it's going to be a green project that has positive social or environmental outcomes. They can see where the money's going, and they can see how the project did, and they can measure the outcomes. So that's why, you know, they can measure the impact that they have with the dollars used for that. A classic example of this is Apple. So a few years ago, Apple issued two green bonds, to the tune of $2.5 billion. And they are using the proceeds from that bond, or those bonds, I should say, to move their entire operation to renewable energy. So they're doing things like building green buildings, creating energy efficiency programs and new programs for recycling and material recovery. So the proceeds from that bond are going to a known project for them to ultimately be 100% run on renewable energy. So I mentioned that there's a lot of growth in the inclusionary space. There's a lot of growth across the board with respect to sustainable investing. What we're looking at here is the Forum for Sustainable and Responsible Investment does a survey every 2 years. And they've been doing this since the 90s. I'm showing you the last 10 years here, but it basically gathers assets that are being managed in the US that incorporate some kind of ESG or environmental, social, and governance factors into their process. And you can see that in 2010, the assets were $3.1 trillion. And they just released the 2020 study a few weeks ago. The assets have grown to 17.1 trillion. So that's a 452% increase in assets over the last 10 years, managed according to these strategies. That's an average of close to 19% a year growth. So you can see the dollars are really flowing into this area. And I think that's a function of the strategies are getting more sophisticated with the inclusionary investing, with the data that's available. It's getting more interest from people. It's definitely getting a lot more press. It's had more press just in this year alone than I've seen in the years past. And you can see that playing out with the asset growth. So with all that said, why does one want to invest sustainably? From what I see and what I read and what I see mostly with my clients that I invest sustainably for is that it aligns with their values first and foremost. That's sort of their main reason for wanting to do this. Of course, they want a good return on their investment, but they want to know that what they're doing with their dollars aligns with their values, and they can feel good about where the companies that they're investing in. And what I tell people is that this is not a perfect science and it's an evolving space and there's no perfect company out there. But there are definitely companies that are making a full force effort to move in the right direction. You'll see in the press, you see it a lot, pretty high profile companies making commitments and pledges to do better for the environment, to do better socially, to make positive changes in the way they run their businesses. Many of these companies also put out what's called sustainability reports. These are not required by the companies. And when you look at some of them, you can see there was a lot of effort and resource put into it. So yes, in some ways it's a marketing piece for them, but it really does show their commitment to this. And so as the dollars continue to flow in there, what I believe a benefit of this is companies are going to be more and more aware. And as high profile companies continue to do this, other companies are going to follow suit, especially competitors, and then smaller companies. So what that's going to do is promote more responsible companies out there. And it's just going to be a positive kind of snowball effect. And the more responsible companies you have out there, the more products and services you have that are going to yield benefits for the community and the environment. So I think it's all moving in a positive direction. And I think that it's, you know, on top of being able to align with your values, it's going to yield in a lot of other beneficial results. And I think the end all be all result is that it's going to build long-term value for these companies. I strongly believe that these companies are going to come out on top in the long run because they're just going to be better companies for it. And so we're going to build long-term values for the company. And what that's going to translate to is building long-term value for not just the stockholder, which is important in a public company. You want to build long-term value for the stockholder, but it's also going to build long-term value for all the stakeholders involved, like their employees, like their suppliers, like the community that they do business in. It's going to build long-term value all around. So I think it's a positive thing, and it's a very big reason to invest sustainably. So the last thing I wanted to just touch upon is performance. So I won't dig deep into performance, but there is what I believe a misconception out there that if you invest sustainably, you have to give up performance. That this type of investing underperforms, say, traditional investing. And the data here doesn't show that's the case, and I don't believe that's the case. So what we're looking at is trailing returns for a 1, 3, 5, and 10-year period on 3 indexes of sustainable companies. So that's the first 3 bars in each of the time periods. The green, the gray, the black bars are all indexes of sustainable companies. And what I'm comparing them to is the gold bar on the right of each category. And that's the S&P 500. That's the S&P 500 you hear about every day on the news, just a traditional index. And the reason I chose these 3 indexes is that they're fairly comparable to the S&P 500 in the kinds of companies that they hold, but also all 3 of them have been around a long time and they have a history that we can look at. This is real live history, and they've been around more than 10 years, so we can look at a 10-year period. So looking at the 1-year period, you can see that sustainable investing has significantly outperformed. Now, there are reasons why that's happening in the past year, and one of the big ones is that the price of oil has dropped significantly this year and has impacted the energy sector, which has also dropped significantly this year. Given that sustainable funds tend to either have a lower allocation to energy companies, or in some cases they don't have any allocation to energy companies, they're going to benefit from that. So you see some pretty significant outperformance for the 1-year period. That's not necessarily going to continue. That's a short-term kind of anomaly. And at Meyer Capital, we're extremely focused on the long term, and we don't necessarily base our decisions and our investments on short-term periods. So as you start to look further to the right in the longer term periods, and even as far over as the 10-year period, you can see that sustainable investing is still either very much in line with the S&P 500, or in some cases outperforming the S&P 500 for a couple of these indexes over a long 10-year period. So I do believe that's a misconception, and I think a lot of this has to do with the advent of inclusionary investing and better diversification. You're getting better performance from that. And I think you truly can invest sustainably, invest with your values, and still earn the same kind of return you would have earned if you don't. And it'll allow you to do something that we like to say at Meyer Capital: you can invest well and you can live well. Right, Tom?
Yeah, absolutely, Michael.